Now speaking, Jen Landis, Head of Investor Relations. Good morning and thank you all for joining us. Today, we will be discussing our quarterly earnings report. Our results show that we have achieved strong financial performance in the quarter, with revenue increasing by 8% year-over-year and net income increasing by 10%. We have also seen a significant increase in our cash flow, which is up by 15% compared to the same period last year. Additionally, we have made progress on our strategic initiatives, including the launch of new products and services, as well as the Now speaking, Jane Fraser, Chief Executive Officer. Good morning everyone. This quarter, the global economy has been resilient, although the macro backdrop differs across key markets. Central banks have made it clear that the cycle of hikes isn't over yet. In the US, the tight labor market is pushing the timing of the recession later into this year or 2024. The Eurozone has exceeded expectations, but is facing pressure from labor and energy costs. China's growth has decelerated after an initial post-reopening pop. Citi has seen the benefits of its diversified business model and strong balance sheet. Revenues, ex-divestitures, are relatively flat to last year, and expenses are on track to meet guidance for the year. Services revenues were up 15%, driven by net interest income and non-interest revenue. Securities services revenues were also up 15%. Markets revenues were down 13% due to low levels of volatility. Banking revenues were down 24% due to a lack of investment banking activity. Cards businesses had double-digit revenue growth. Wealth revenues were down 5%. Expenses were elevated this quarter due to repositioning actions. Citi is committed to bending its expense curve by the end of 2024. Capital was increased to its stress capital buffer, but Citi is confident in its ability to reduce its capital ratios and return capital to shareholders. We ended the second quarter with a CET1 ratio of 13.3%. Now speaking, Mark Mason, Chief Financial Officer. This resulted in net income of approximately $1.3 billion, up 4%, and in ROTCE of 11.2%. Average loans were up 6%, driven by growth in cards, partially offset by a decline in mortgages. Average deposits were up 5%, driven by strong growth in operating accounts, as we continue to win new clients and deepen relationships with existing ones. And our net interest margin increased 8 basis points. On slide 13, we showed the results for our corporate and investment bank. Revenues were down 17%, driven by lower revenues in markets and banking, partially offset by growth in services. Expenses were up 10%, driven by continued investments in risk and controls, as well as approximately $120 million of severance in investment banking and markets, partially offset by productivity savings. Cost of credit was $58 million, driven by net credit losses, partially offset by an ACL release. This resulted in net income of approximately $1.2 billion, down 44%, and in ROTCE of 9.2%. Average loans were down 6%, reflecting discipline around our strategy and returns. Average deposits were up 1% as we continued to acquire new clients and deepen relationships with existing ones. Good morning everyone. I'm pleased to report that our second quarter financial results were strong, with net income of approximately $2.9 billion and an EPS of $1.33 and an ROTCE of 6.4%. Excluding divestiture-related impacts, EPS was $1.37, with an ROTCE of 6.6%. Total revenues decreased by 1%, both on a reported basis and excluding divestiture-related impacts, as strength across services, U.S. personal banking, and revenue from the investment portfolio was more than offset by declines in markets, investment banking, and wealth. Our expenses were up 9%, both on a reported basis and excluding divestiture-related costs, driven by a number of factors, including investment in risk and controls, business-led and enterprise-led investments, volume growth, and macro factors, including inflation, as well as severance. We maintained a very strong $2.4 trillion balance sheet, which is funded, in part, by a well-diversified $1.3 trillion deposit base across regions, industries, customers, and account types. Our CET1 capital ratio was 13.3%, which includes a 100 basis point internal management buffer. We reported an ROTCE of 8.7% through the first half of 2023. In our institutional clients group, revenues were down 9%, driven by lower revenues in markets and banking, partially offset by growth in services. In Treasury and Trade Solutions, revenues were up 15%, driven by 18% growth in net interest income and 8% in non-interest revenue. In Security Services, revenues were also up 15%, driven by higher net interest income across currencies. In markets, revenues were down 13%, driven by both fixed income and equities relative to an exceptional quarter last year, coupled with low volatility this quarter. In banking, revenues, excluding gains and losses on loan hedges, were down 22%, driven by investment banking as heightened macro uncertainty continued to impact client activity, as well as lower revenues in corporate lending. In our personal banking and wealth management business, revenues were up 6%, driven by net interest income growth of 7%, partially offset by a 6% decline in non-interest revenue, driven by lower investment product revenues in wealth. Cost of credit was $1.6 billion, driven by higher net credit losses as we continue to see normalization in our card portfolios, and a reserve build of approximately $335 million, primarily driven by card balance growth. This resulted in net income of approximately $1.3 billion, up 4%, and in ROTCE of 11.2%. We remain in line with our full-year guidance of roughly $54 billion, excluding divestiture-related impacts and the FDIC special assessment. We are well reserved for the current environment with over $20 billion of total reserves and a reserves-to-funded loans ratio of approximately 2.7%. We have approximately $584 billion of HQLA and approximately $661 billion of loans. We maintain total liquidity resources of just under $1 trillion. Our LCR was relatively stable at 119%, and our net stable funding ratio was greater than 100%. We expect our regulatory capital requirement to be 12.3% in October of 2023. We are making progress against our strategy in ICG, with strong client wins in Treasury and Trade Solutions, and healthy underlying drivers in Security Services. We continue to grow prime balances in markets, driven by client wins, and corporate client flows remain strong and stable. We are pleased with the progress in Security Services as we continue to onboard assets under custody and administration, which were up approximately 11% or $2.4 trillion. We feel very good about the pipeline of new deals in Security Services. In personal banking and wealth management, average loans were up 6%, driven by growth in cards, partially offset by a decline in mortgages. Average deposits were up 5%, driven by strong growth in operating accounts, as we continue to win new clients and deepen relationships with existing ones. Our net interest margin increased 8 basis points. We believe the investments that we've made in healthcare and technology coverage will benefit us over time. We will continue to reassess how and where we deploy capital, and we will continue to reassess the appropriate level of our management buffer over time. Evercore IC analyst Glenn Schorr inquired, could you provide more insight into the reduction of the subscription credit facility from $80 billion to $20 billion and how you are balancing the capital benefit with the client impact? Mark Mason replied, thanks, Glenn. We've been focused on optimizing our balance sheet to improve returns over time. We've reduced our subscription facility and credit facility lending significantly, and we've selectively taken down pieces of the portfolio where clients aren't taking advantage of our broader franchise and returns are low. We've reduced RWA by $120 billion in the last 2 years, with 75% of that driven by balance sheet optimization. We'll continue to do this proactively as regulatory changes come into effect. Evercore IC analyst Glenn Schorr inquired, what factors are driving the $1.5 billion increase in NII markets in the first half of the year? Mark Mason replied, we've taken guidance up to slightly above $46 billion, driven by a combination of headwinds and tailwinds. Headwinds include reaching terminal betas in the U.S., deposit volumes, and wind downs and exits. Tailwinds include rate movements from non-U.S. dollar and card volume growth. We believe this is the right level in the context of total revenues at $78 billion to $79 billion. Seaport Global Securities analyst Jim Mitchell inquired, how can we expect the non-legacy businesses to bend the curve in terms of expenses? Is there a quarterly or year-over-year decline? Mark Mason replied, I'd like to reiterate our expense guidance for the full year, which is roughly $54 billion, excluding divestitures and FDIC special assessment. We're focused on bending the curve from Q3 to Q4 and continuing that trend through the medium term. This will be achieved through exits, investments in transformation, risk and controls, and simplifying our organization. We're confident that we can deliver on this goal. Seaport Global Securities analyst Jim Mitchell inquired, can you provide an outlook on the core business expenses in 2025 and beyond? Mark Mason replied, it's a combination of continuing to reduce our expenses and increasing our top-line growth that will drive our operating efficiency. We are confident that our guidance of less than 60% operating efficiency is achievable. Morgan Stanley analyst Betsy Graseck inquired, is the 13.3 CET1 buffer in line with your plans going forward? Mark Mason replied, we hit 13.3 this quarter, down from 13.4 last quarter. The 4.3% SCB comes into effect October 1st, which would equate to a 12.3 regulatory requirement and a 13.3 target. Our strategy is designed to bring more steady, predictable revenue growth and reduce expenses, which should reduce the stress capital buffer and improve returns. Morgan Stanley analyst Betsy Graseck Inquired, how should I think about the potential for buybacks relative to the upcoming Basel endgame? Jane Fraser replied, given the current macroeconomic and regulatory environment, we are taking a prudent approach to capital management. We have increased our dividend and returned $2 billion of capital last quarter, and we expect to maintain our current levels of capital, including the management buffer, for the rest of the year. We will continue to assess this situation until more clarity is provided on the new capital requirements and their timing of implementation. Wells Fargo Securities analyst Mike Mayo inquired, what are the cost-cutting measures you have implemented to reverse the trend of increasing costs in the second quarter year-over-year? How are you leveraging TTS's double-digit growth to monetize greater money in motion among your multinational and other clients? Jane Fraser replied, thanks, Mike. We've been transparent about our investment spend related to transformation and beyond. We're on track for the $54 billion expense guidance, excluding FDIC and divestitures. We'll continue to reduce expenses by leveraging 3 levers: exits, remediation work, and simplifying the organization. We'll keep you updated on our progress and aim to build a track record of doing what we say we will do. Mark, anything to add? Mark Mason replied, in addition to the transformation initiatives Jane mentioned, we are taking repositioning charges to reduce expenses over the next 12 months. These charges will help us navigate the uncertain period of time where wallets across certain parts of the industry are under pressure. Jane Fraser replied, we're seeing great growth potential in TTS, with high returning business and strong indicators of monetization. This quarter, we saw new client wins up 41%, a sustained win-loss ratio of 80%, and fee growth of 11% for cross-border, 6% for US dollar clearing, and 15% for commercial cards. We continue to invest in the business to ensure that 80% win ratio, such as launching 24/7 $365 clearing and an instant payments platform for e-commerce clients. In security services, we've seen 65% client wins versus last year, and have increased our share with asset managers in North America from 2.6% to 4.3%, with a target of 5.5% by 2025. UBS analyst Erica Najarian inquired, can you provide clarity on the magnitude of the expense reduction that can be achieved in the core business over the next 5 years? Mark Mason replied, I'd say that we have invested more in our franchise to ensure safety and soundness and move toward a more automated, modernized operation. This will increase our expense base, but also yield efficiencies over time. We have $7 billion of expenses associated with legacy franchises, which will come down, but the Mexico transaction will delay this. We have given guidance on top-line revenue growth of 5% CAGR and operating efficiency targets, and we intend to deliver on these. We are also being responsive to the current environment and making progress on simplifying the organization, which will help us reach our lower cost base. Jane Fraser replied, we are laser-focused on executing our plans to ensure we reach our goals. We are highly involved in making sure this happens for each of the drivers Mark discussed. UBS analyst Erica Najarian inquired, is it just a timing issue or are you still uncertain of the amount of reinvestment needed to achieve a 5% revenue CAGR? UBS analyst Erica Najarian inquired, can you provide more detail on the expenses associated with the curve bending? UBS analyst Erica Najarian inquired, have you made decisions on how to allocate the expenses associated with the transformation Jane discussed? Could some of those expenses be used to grow revenue and achieve the 5% CAGR goal? Mark Mason replied, I can confirm that our revenue CAGR will be impacted by volume-related expenses. We are also focused on non-volume-related expenses, and the magnitude of the bend is a factor. For example, Mexico has impacted the magnitude of the bend. We have invested in Mexico to drive top-line revenue growth, and we will continue to make investments to maintain our competitive advantage. We will provide concrete numbers as we get closer to 2024 and give more direction on the magnitude for that year and beyond. Wolfe Research analyst Steven Chubak inquired, can you explain why the 11.5 to 12% capital target remains appropriate in light of recent SCB increases in Basel III endgame? How will asset sales translate into operational risk capital relief? Jane Fraser replied, I'm confident we'll meet our 11 to 12% ROTCE target over the medium term. Our core drivers remain unchanged, 4 to 5% CAGR revenue growth, reducing expenses by the end of 2024, and optimizing our balance sheet. We're leveraging levers like capital allocation, DTA allocation and utilization, GSIB score, and a 100 basis point management buffer to support RWA and capital optimization. We'll have to work through the implications of future capital requirements once they're known, but we're confident in our path to execution. Mark, let's discuss consumer market sales and operational RWA relief. Mark Mason replied, in response to the question, I can say that our transactions to date have freed up $4.6 billion of capital and the 2 remaining transactions this year will generate an additional $1.2 billion. We are hopeful that the regulators will take our views into account when they release the proposal. We believe that exiting these 14 markets will reduce our stress scenarios and risk-weighted assets, as well as operational risk. We will assess the proposal when it is released and figure out how to manage through it, whether that be exiting certain products, seeking price adjustments, or optimizing RWAs. Jane Fraser replied, as the recent test results have shown, U.S. banks are in a strong capital position and have been able to play an important role in stabilizing the system. We take this role seriously and hope that the capital frameworks take into account the impact on U.S. competitiveness. We need a level playing field with Europe, not a gold-plated one. We are concerned that higher capital levels will increase the cost of capital for medium and smaller-sized enterprises and consumers, driving more activity to non-regulated and lesser capitalized players. We hope that this is taken into consideration when making decisions, as we will take pricing actions accordingly. Wolfe Research analyst Steven Chubak inquired, given the lower partner payments, what drove the weakness in wealth fee income this quarter? Is it something that you expect to persist, especially given the market tailwinds? Mark Mason replied, wealth was down 5% this quarter due to macroeconomic factors such as rates, inflation, and the prospect of a recession. This has caused customers to shift into higher-yielding products from deposits and fee revenue from investment management to increase. Despite this, we are seeing strong referral momentum from our retail banking business into our wealth business, with 25,000 referrals year-to-date. We have also seen an increase in the number of clients onboarded in both the private bank and across wealth. These are positive signs that position us well for when greater certainty returns and clients start to invest again. Bank of America Merrill Lynch analyst Ibrahim Poonawala inquired, Mark, what unemployment rate did you reserve for and how would a change in the job market affect credit reserves? Bank of America Merrill Lynch analyst Ibrahim Poonawala inquired, what is your unemployment rate assumption and how would a worsening outlook affect provisioning? Mark Mason replied, our current reserves are based on a mix of 3 macroeconomic scenarios, base case, upside, and downside. We weighted unemployment at 5.1% over the 8 quarters, which is roughly flat to last quarter. Our downside scenario assumes a higher unemployment rate of 6.8%. Each quarter, we review macroeconomic factors and adjust our weighting of the 3 scenarios accordingly. In addition to unemployment, we also consider debt service coverage ratio when assessing consumer risk. We have $20 billion in reserves and feel confident in our level of reserves. Bank of America Merrill Lynch analyst Ibrahim Poonawala inquired, can we expect to hit the ROTCE target by 2025 given the Basel changes? Mark Mason replied, I point out that our medium-term returns are 11 to 12%, with a medium-term goal of 25 to 26%. We remain confident in our ability to reach this goal, and we are working to optimize our balance sheet while serving our clients and growing our high-return businesses. Deutsche Bank analyst Matt O'Connor inquired, what are your expectations for normalized loss rates exiting this year and early next year? Mark Mason replied, thanks for the question. We still anticipate both portfolios to reach their normal levels by the end of the year. Our reserves, delinquencies, portfolio mix, and customer behaviors all factor into our expectations. We expect the portfolios to exceed their normal levels before returning to them, depending on how the mild recession plays out. Jane Fraser replied, I'm confident in our positioning as a prime and strong credit proposition. We're seeing increased demand for our credit-led products, such as value cards, bulk-on, installments, and loans, as well as service-led engagement for our prime customers. This will be a key factor driving growth and profitability. Deutsche Bank analyst Matt O'Connor inquired, what are your thoughts on the card industry's ability to reach normalized levels of losses in the near term given the current economic environment? Jane Fraser replied, I believe the U.S. consumer is resilient. We've seen more pressure on lower FICOs, but our portfolio is not heavily impacted. We're seeing normalization in payment rates and other behaviors, but overall, I don't think we should be overly concerned about the health of the U.S. consumer. In this unusual environment of higher inflation, low interest rates, and a strong labor market, the debt service ratio is a more useful leading indicator to monitor. RBC Capital Markets analyst Gerard Cassidy inquired, Mark, what has enabled your customers to remain healthy despite a 500 basis point increase in interest rates? Mark Mason replied, Gerard, our focus is on large multinational, investment-grade quality companies with strong balance sheets. We are proactively managing the prospect of a recession by looking at expenses and increasing efficiency. Additionally, many firms have been proactive in the low-rate environment to ensure balance sheet strength. We anticipate a rebound in capital market activities, which will be reflected in our very low NOL and credit losses. RBC Capital Markets analyst Gerard Cassidy inquired, given the Fed's tightening over the last 12 months, how have you positioned your balance sheet and what changes do you anticipate going forward? Mark Mason replied, we actively manage our balance sheet to meet both client needs and the changing macro environment. Our Qs show our view on interest rate exposure and how a 100 basis point swing in rates affects us. Last quarter, that estimate was around $1.7 billion, heavily skewed toward non-US dollar currencies. This quarter, we expect that number to decrease and skew even more toward non-US dollar currencies, with the US dollar being neutral. We consider both client demand and central bank guidance when making decisions. Wells Fargo Securities analyst Mike Mayo inquired, "What initiatives have you taken to bend the cost curve, and how far along are you in each of them?" Mark Mason replied, "Mike, we're making good progress on closing our exits and reducing the stranded costs associated with them. We're confident that by the end of the year, excluding Mexico, we'll have made considerable progress. We're also investing in transformation spend to simplify our organization and execute our plan. This is a multi-year journey, but we know what we need to do to invest in technology, people, and reduce operational expenses. We're committed to being disciplined about our cost structure and bending the curve." Wells Fargo Securities analyst Mike Mayo inquired, "What is the cost of the transformation remediation and how many people are working on it?" Mark Mason replied, "I can confirm that we have approximately 13,000 people working on our transformation efforts. We are managing the cost of these efforts very closely and looking for opportunities to deliver more efficiently, leveraging technology and AI where possible. We are also continuously evaluating our execution plans to ensure we are achieving maximum efficiency." Jefferies analyst Ken Usdin inquired, "Mark, what is the sentiment around client activity in the markets group and investment banking?" Jane Fraser replied, "Corporates are being cautious due to the Fed hike, tensions between China and the West, and OPEC. Clients have accepted the current environment as the new normal and are positioning themselves globally. We're seeing less anxiety around funding as large core are paying higher rates to take advantage of issuance windows. Balance sheets are getting reinforced. The M&A pipeline is robust, but it's hard to predict when it will unlock. ECM had tangible momentum over Q1, and sponsor activity is showing signs of improvement. Investors stayed on the sidelines in Q2, but there has been a light bump in volatility the last few days." Portales Partners analyst Charles Peabody inquired, "What drove the increase in markets-related net interest income in Q2 compared to Q1, and what accounts for the positive NII outcome relative to other money-centered companies?" Mark Mason replied, "Thanks for the question. Our markets NII is driven by dividend season, which plays out over the first and second quarter. Our book skews more towards corporates than peers, and we have a strong FICC business. So, dividends are a major driver of the increase in NII." Portales Partners analyst Charles Peabody inquired, "Can you provide any directional guidance on markets-related NII for the second half of the year?" Mark Mason replied, "Charles, I appreciate your question. NII increased to plus 46, however, I won't be providing any further guidance on the breakout of the NII. Thank you." JP Morgan Chase & Company analyst Vivek Juneja inquired, "Should we expect the capital ratio to grow in anticipation of upcoming regulations, or will you try to keep it close to 13.3? Jane Fraser replied, "Given the framework that is expected to come out, we will assess the implementation timeline and make necessary adjustments to our plan. We are taking the comment period seriously and considering all the factors discussed earlier. We will adjust pricing, capital reallocations, etc. as part of our usual playbook. We anticipate our SCB to be in a different place due to the shifts in our business model, which should result in a decrease." Mark Mason replied, "The CET1 ratio as of October 1 was 13.3, with a regulatory requirement of 12.3 and a management buffer of 100 basis points. Jane mentioned that the NPR will be taken into consideration to determine any implications on the CET1 stack or risk-weighted assets." Mark Mason replied, "The timing of the implementation of the final rule is key. It gives the industry time to consider how to absorb the implications of the rule." JP Morgan Chase & Company analyst Vivek Juneja inquired, "What is your timeline for returning to the markets?" Mark Mason replied, "I'm eager to review the proposal and assess how it will affect our industry and our company. We'll be able to provide a more informed response once we have had a chance to review the details." JP Morgan Chase & Company analyst Vivek Juneja inquired, "What has been the trend in non-interest-bearing deposits among your corporate clients this quarter, and what have you factored into your NII guidance?" Mark Mason replied, "Clients are shifting from non-interest-bearing deposits to higher-yielding products, such as interest-bearing accounts and CDs, due to the current rate environment. In the U.S., corporate clients have reached their terminal betas, while outside of the U.S. rate hikes are still in the future. We are seeing this dynamic play out with non-interest-bearing deposits."